the first question out of their mouth is typically, how do I value my business? What's the biggest component of valuation, or one of the two big components?
How much money do you make? That is the biggest thing that goes into valuing a business.
In today's economy, more people than ever are looking to buy and sell businesses. But how do you do it? Welcome to the Deal Board, presented by Transworld Business Advisors. Straight talk about real deals and real people. Listen to stories, interviews, and expert advice to help your business sale, merger, or acquisition process. Now, here are your business exit experts, Andy and Jessica.
Welcome back, everybody. And today on the Deal Board, we have one of our most requested topics. So I don't know about you, Andy, but whenever I tell somebody what I do, the first question out of their mouth is typically, how do I value my business? Right? And all the time. And what's the biggest component of valuation, or one of the two big components?
How much money do you make? That is the biggest thing that goes into valuing a business. And it's really the most important thing. We could talk about assets. We could talk about similar size business, comparing them on sales. But really, if somebody's going to give you money, they want to be able to make the money back, get a return on their dollar. And so we need to accurately know what a business makes so we can properly value it and get you a great buyer at a great price. And get financing, as we were just talking about before we started this.
Yeah. So what we do is we look at how much money the business makes the owner. And there's two earnings numbers that we look at depending on the size of the business. The first is EBITDA, or earnings before interest, taxes, depreciation, amortization. And the second, the one we use most often for small to mid-sized businesses, is SDE, or seller's discretionary earnings. It's also called seller's cash flow, sometimes just cash flow. You see it has a lot of different names, DE. But today we're going to talk about how you calculate that number, that SDE. And the baseline formula is that you have your net profit, and then you're going to add back certain expenses. And I know, Andy, when we first started talking about this and educating on add backs, at least when I started over 10 years ago, I feel like this was a new topic for business owners, but I feel like there's been a lot of great education in this space, and business owners are more aware of what an add back is. But the question is, what can I add back, or what qualifies as an add back?
Yeah. And we want to make sure that as an industry that we educate everybody. So we're all dealing and comparing the same things. We're comparing apples to apples. And the reason we recast, of course, is because everybody wants to minimize their earnings so they pay less taxes. And there are legitimate ways to lower your earnings. And there are some gray area ways. And then there are some just downright fraudulent ways. And we have to sometimes deal with all the above. And so we're going to go through a list of things that we typically look at and will recast or add back in. That's again, an interchangeable word: recast, adding back, normalizing, adjusting. It's all about taking that expense and then removing it or adjusting it so the earnings do go up or down, depending on what we're looking at on those numbers. Because at the end of the day, what we're looking for is a representative earnings that is going to happen again, because businesses are valued based on what it's going to make in the future. The simple person's way to figure that out is to look back. And when we look back and we're doing these recasts, we're trying to normalize things to say, this is what you're going to make based on these assumptions.
Yeah. And so before we jump into our list, I think we should talk about just our philosophy overall at Transworld. So as a brokerage firm in general, we are a bit more conservative than other brokerage firms, meaning that we're going to stay more on the black and white side of add backs than those gray areas and even those fraudulent areas. And there's a few reasons we do that, right, Andy?
Yeah. I mean, we have proven that we sell businesses at a higher price. We get more deals done with SBA lenders because they believe our recasts, and we get through due diligence. And we do all those things because we're a little bit more, we do scrutinize things a little bit more, and we do kind of guide our sellers to not be overzealous in some of these add backs, because what happens is people feel like they get bait and switched. They get a big number or an unrealistic number that really in due diligence, all of a sudden it fails in due diligence. And as we say, the seeds of inconsistency grow wildly once one seed is found. So one little mistake that is made in one adjustment or one overzealous, then a buyer will think, or an accountant that's reviewing these financials automatically assumes that everything else needs to be called into question. So we're very careful. We try to be very careful.
Yeah. And if you look at the SDEs we have compared to our competitors of our listings, same size businesses, usually they're lower, right? Because of that. But like you said, Andy, I equate to red flags, right? So if you're overzealous with your add backs, when you get into due diligence, I don't even want to call a savvy buyer, but a buyer that's paying attention, a bank that's paying attention, they will pick into those add backs. And each one that's a little questionable will raise a red flag. And what I find with buyers and even bankers and partners is that once there's one red flag, they question what else they don't know. And it could be even unrelated to financials, right? But it's like you said, that those seeds of inconsistency, the seeds of doubt. And so we would encourage you, Andy and I, to just really think cautiously when you're getting into some more aggressive add backs of how can this affect my deal overall going into due diligence and the success of it? Because in all likelihood, if you are overzealous with the add backs, will it attract more buyers when they're inquiring about the business? Yeah, probably. But they're going to uncover that and do due diligence, and the business valuation is going to get traded down.
Yeah. Yeah, they'll probably unwind some reasonable add backs if you do something that's, overreaching, like, you add back all the postage and you say, oh, people don't have to send postage, or I mail out all my Christmas cards every year. It's like, you don't spend $2,000 a year in Christmas cards, or whatever. So let's go through the list.
Yeah. Well, let's start with the things that are by rule, by definition, an add back. So the first one is interest. So a lot of the normalizing we do is we're going to take away decisions on how certain business owners will run their business, right? So certain business owners are comfortable running their business with debt and using debt to acquire their business or debt to grow their business, and some are not. So we're going to adjust that interest back, and that's in the definition of EBITDA.
Yeah. And we're, again, trying to compare apples to apples. So we're looking for all businesses to be debt-free.
Yes.
So the second one is taxes. And we're talking about income taxes, which most corporations are not taxed federally on, but some states have income tax. And so we add that back. Now, just as a matter of practicality, just because we're adding it back to help value the business, compare it to every other business in the United States, we have to add back state taxes. Now, if you're buying a business, say in Connecticut or somewhere where there are state taxes, and you're going to have to pay those later, perhaps and you want to look at this, people who have state taxes and you're buying a business in those states, you're going to want to see if they added back the taxes, because you're going to have to pay them. Right. So, and again, when you're valuing a business, it doesn't matter, because we're going to value the business all the same way across the United States or even across the world. And we're going to say there are no taxes involved. So we're going to add back taxes.
Yep. And the next two we can probably bucket together, but depreciation and amortization, it's a way to keep up with the value of your assets, both tangible and intangible. It's a non-cash expense. So we're going to adjust those back, again, comparing apples to apples. Different owners use different depreciation schedules. Some don't use it. So just to get everything on the same par level. So those first four, interest, taxes, depreciation, amortization, those are by rule, add backs or adjustment for getting to that standard definition of EBITDA.
There you go. That's where you get EBITDA from.
Yep.
Earnings, interest, taxes, depreciation, and amortization. So then we're going to now start. And if you're buying a big business, and you're a company buying a company, you usually, that's where you stop. That's, and there might be some other normalizations of some things inside the company. We could talk about those later. But, EBITDA is what companies buying companies, because they're going to have to pay someone to run that company. But if you're an individual, and let's say that's businesses that earn more than $1 million, businesses that earn $1 million or less that are going to be run by an individual, we assume that individual is going to be there, run the company and not run the business absentee. So the first thing we're going to add back is officer salary. And that's for one officer only. If there's two officers in a business, a husband and wife team, and they're both being paid, we're going to only add back, because we're going to assume that one buyer is buying the business, one buyer is going to run the business. So if there's two officers that are being paid, you're going to have to replace that officer.
I think the key there to officer's salary, and this is related to the next two actually, is it's a W-2 salary. So if you're taking distributions from your business, that's already reflecting your net profit. So you're not adding that back because that's already in that net. This officer salary is just your W-2 salary. And related to that, you also want to add back the employer contribution for your payroll taxes, pensions, 401k, any benefits that you get related to that W-2 salary that the company takes on.
Right. So now we're going to dive into everything else. And a lot of this stuff has to do with owner perks or adjustments that need to be made because something is happening in the business that we have to reflect what the future of the business is going to be. So number 8 is the perks of the owner. And it could be several things inside of that. But the most common things are auto expenses, auto insurance, life insurance, and health and disability insurance. And so we add those things back. Now, the new owner might need those things, but they might have a different car. They might be a different age. Therefore, life insurance and health insurance will be a different price. We add them back because these are the things that we know, that you're going to have to buy yourself, or you'll have that money to buy those things.
And I think one good thing I learned from you about recast, Andy, is that a good question to ask yourself in these perks is that if you replaced yourself, you hired a president to run the company or GM, and that GM would need an auto expense, right? Then that may not be an add back, right? So if it's industry standard or job role standard that employee would get these perks, then they're not add backs. But
yeah, and sure, if you have to use your car in your business, and we've had this with florist shops, and we've had this with construction companies where they're driving a truck and the truck has tools in it, or they're a plumber. That is not something you get to add back. This is somebody that buys a car for themselves and is writing off against the company. Whether or not that's legitimate, business owners do sometimes take an aggressive stance on writing off as much expense as they can get to save on taxes. Mm-hmm. So a lot of CPAs will kind of adjust. But so we do add those back if we think it is discretionary in nature.
Yeah. So the next one's a big one we see in almost every business, but telephone and cell phone expenses. And here we see that it's not just the owner's telephone and cell phone, which I think is a bit controversial these days. Not a lot of businesses have standardized business landlines anymore. Like I joke all the time, I don't even think my son's going to know what a landline is when he grows up. So that cell phone expense, you got to be careful with it because for the owner, it's probably necessary to run the business. Now, we usually see that the family plans are all looped into that cell phone bill. So the best course of practice there is just to make sure you have a really good itemized bill. So you can separate what is a business line, like the owner's line, and then some non-business lines. Obviously, to keep it the cleanest, if you have a few years away from sale, try and split out that personal versus the commercial cell phones.
And so we didn't talk about this yet, but when we're going to do some of these adjustments, sometimes we look at how significant these adjustments are, right? So if phone bills have over the years have come down somewhat, So now if we're talking about 40, $50 a month, it's it's $600 a year. We might want to skip that in a company that has hundreds of thousands of dollars worth of earnings, because we don't want to look overzealous and we don't want to look like we're grabbing every dollar. And therefore, if we're in due diligence, we'll say, oh, you'll probably save some money here and there on some of these other things.
Yeah. Yeah. I think it's a good point. So
Yes.
Another big one is just real estate. And this whole category can really have a lot of different adjustments.
Yeah. I mean, if you own real estate, we automatically assume that is a non-operating asset of a business. So if you have real estate, if your business owns the building, we will impute a rent, and then we will take out all the expenses of owning that business, whether it's getting depreciated, whether there's interest payments in the note. Now, most people do separate it and they put it into its own corporation. But what happens is sometimes they're paying themselves, quote unquote, they're paying that other corporation rent. And sometimes that rent is only large enough to cover the mortgage payment and perhaps taxes and insurance. So what happens there is that we have to impute a higher rent because that business is perhaps too profitable. And, again, maybe they're not selling, because sometimes owners tell us, well, we want to hold on to the building and collect rent. It's like, well, how much rent do you want to collect? Well, double what we're collecting from ourselves now. So we have to make that adjustment.
Yeah. And that's where you can have what's called a negative adjustment, which reduces your seller's discretionary earnings. I just had a call with a client yesterday that took my advice a few years ago. They bought their building, they put it in a separate entity. They wrote a lease between the two entities, and they started charging their business entity full market rent. So I said, are you happy with the rent the business is paying the real estate entity? Because they wanted to keep the real estate. And they said, yes. So now we're all set and we don't have to make any adjustments to that. However, this can also happen when you don't own your building. So a lot of our clients, Andy, have owned their businesses for years and sometimes decades, and they may have a grandfathered or sweetheart rent deal. Especially in some of these markets that we've seen rent accelerate over the last 10 years really significantly. So if we know that a business is not paying market rent and we don't have a solid assignment clause in that lease where when we go to the landlord, we know the landlord's going to increase the rent, at times we will do that negative adjustment to SDE, add more expense to the rent just to normalize it, right?
Yeah. And sometimes, it's funny, over the years, we had the situation where somebody was talking about doing a positive adjustment because, they were going to get a deal on rent. And I'm like, that never happens. And then 2009 and 2010 rolls around. And guess what? That might happen again. The commercial real estate world has 20% vacancy right now. And if we're selling a business that's in an office, that could either downsize because they have remote workers, or they're going to get a deal on their rent because, there's all this rent space coming up for sale. It'll be interesting. So we might adjust the rent one way or another based on what we think is going to happen in the future.
Yeah. And just a note on that, I think that's when you're working with your business broker, you're working through this, it's really important to have them do a review of your lease too, because a lot of those terms in your lease will dictate how that negotiation is going to go with the landlord once we get into due diligence.
So many people think they have an option on their lease, or their option will holds the price or with a certain escalator, and it doesn't. It says, it is market upon the renewal of an option. There's a lot of surprises when it comes to leases. Everybody forgets the dates too. So yes, good point. Get your lease out, and we all need to read it. So the next thing that happens is payroll. Now, a lot of times in businesses, they have family members, and those family members sometimes are non-essential, right? They're paying their wife, or they're paying their husband, or they're paying their kids, or they're paying their parents, and nobody works in the business. So we would immediately add that back, and that would be a positive, increasing the earnings. There can be a negative though to that. So a lot of times family members work for the business and they're underpaid or not paid at all.
Yep. Yeah. And I think this is one you have to be careful with too. I've seen some clients say, well, I pay my wife a salary to do bookkeeping, but she doesn't really work that much and the owner could do it. And they start piling all these other responsibility onto this new owner. And so you just have to be careful. Again, I think this is our overarching, and you just don't be overzealous and these adjustments that you're making. So.
And then we have a couple that we're going to look at, and we always look at the numbers. So there's donations, right? So donations comes up, and a lot of times it can be legit donations. Like we had a hospice company, and they supplied hospice units with medical supplies. And guess what? They were the #1 sponsor of the annual golf tournament for this large hospice company. I would say that is not discretionary. That's business. And that company expects them to be the largest donor to their charitable fund, and they do it. So that's not, but like, listen, people do things like baseball teams, or they have a personal charity that they're involved with that they donate a lot of money to, or they join things like the opera or the theater and they pay for it through business. Those things are discretionary.
Yeah. And it's really related to the next one too, which is also dues and subscriptions. A question I tend to ask clients is, are you getting any benefits or business from this organization? And if the answer is yes, then it's not discretionary. So one I'll use one of my examples, dues and subscriptions. I've talked before that I'm really involved in entrepreneurs organization. Is it discretionary? Yes. Do I get business from the organization and key relationships? Yes. So adding that back in my case would be definitely on that line in that gray area.
We had someone that had their #1 client. They shared tickets to the Miami Heat game, and they shared a box. It was $125,000 a piece, and they both shared the box. And we actually added it back, and the buying group accepted that add back because they said they didn't want the box themselves. And I'm thinking, you don't want a box with the #1 client for your company. But, again, sometimes we put it in there, and, it's up to whether or not they're going to accept it. The next one is bad debt. Now we're going to look at bad debt and decide whether or not it was a one-time occurrence and it wasn't done in the normal course of business. So say, for instance, right now you had a debt with WeWork, and they just went bankrupt yesterday or the day before. And if you're listening to this, it'll be several weeks ago. If you had accounting, you had a receivable due from WeWork, and now you're going to have to write that off. Say it was $50,000 that you did electrical work for one of their build outs. You're going to get stuck with that $50,000. That's going to be bad debt. If you're selling that electrical company, we would not assume that you're going to have $50,000 worth of bad debt every year.
Yeah. Yeah. And that one also ties into the next group of them is these one-time non-recurring expenses, right? And so it's extraordinary things that happen to your business. So bad debt, fire, theft, one-time insurance payouts, a sale of a capital asset, litigation, lawsuits. This is another area I think you have to be careful in, because the things that I just named may only happen in a business, hopefully once or twice in the entire lifetime of a business. What you want to be careful of, and I know, Andy, you've seen this too, is be like, well, I tried this marketing thing and it didn't work. So it's a one-time occurrence. It's never going to happen again. Well, we're going to try different marketing and advertising stuff that doesn't work in our business every year. That's normal course of business. We're talking about extraordinary events or occurrences that, again, may happen once, hopefully not more than that in the life cycle of a business.
Yeah, sure. Some businesses need an attorney all the time, and they're going to have legal expenses. Mm-hmm. That's legitimate, and we're not going to add that back. So great points. So the next one is we're going to look at what happens if they lose a big customer or gain a big customer? Again, values of a business are based on future earnings. So if we're halfway through a year, or like right now, we're almost at the end of the year, and they lost a big client just recently, we're not going to go out to the market with the same earnings that we know are not going to happen next year because they just lost this client. Or if they just gained a huge client and their current financials are not reflective of the profit they're going to have next year, we may do a pro forma of next year so we can show people the new value in the business.
Yep. It's very important, especially when that number is significant. Like you said, Andy, we're really looking at these significant numbers. So next area, we're talking about leases again, but not related to real estate, related to equipment leases. And a lot of these leases will have to be paid off at closing. So we will adjust those, the lease expense that's showing up, because since the seller's going to have to pay that off in closing in order to transfer that piece of equipment or that asset, the buyer will not have an ongoing expense on that item.
Right. And then along with that, one-time thing is penalties. And sometimes, certain penalties happen with businesses. And again, we're going to add that back if it's only a one-time expense. But, there's some businesses that have penalties all the time, I guess. But I can't think of one off the top of my head. But, we're going to add back those extraordinary items. And really, the last thing that we're going to look at is we're going to look at every large number. We have seen some crazy things over the years. I saw one company that had royalties as a line item. And I said, "You're not a franchise. What are you paying royalties to?" And he said, "I pay my dad. It was his business to begin with. And I told him I would pay him royalties for the rest of his life." So now that he was selling the business, obviously the next person is not going to have to pay those royalties and would not have that expense.
Yeah. So I think what we didn't talk about too is also really important, Andy. So we've told you guys on this podcast, and I don't even know how many episodes we've mentioned books and records and clean books and records, right? But we didn't talk about adding back personal expenses. We didn't talk about travel. We talked about vehicles a little bit, but I've seen like entire Lamborghinis written off on P&Ls before. We didn't talk about uniforms and clothing and med spa visits and all this other personal stuff, because that's when we're getting into, should we call it the dark gray area or light? I don't know what we would call it, but it's really hard, especially if there's a lot, for us to adjust all of that out of the business. And we know, and Andy started this off with, we know there's adjustments you can make to your net earnings so you can reduce your tax liability. But at the end of the day, like, you just have to make a decision if it's worth it or not, right?
Yeah, when these dark gray areas come up, or even these flat out black areas come up where people are hiding cash, or they're doing crazy things with inventory adjustments so their cost of goods sold go way up or down, or they're doing crazy things like buying things through the business or going to Costco every single week and putting in cost of goods sold. Those things are very hard for us to unwind, and it gets really tricky. And I've seen some big businesses do it where we literally had to go through the black cards of 3 partners who spent things like private jets, and they would extravagant travel and extravagant dinners and concerts and sporting events. And when we added it all up, it was almost another $1 million to this business that was making about 5. And so we did it because, if we're selling, you got to think about this. Every dollar that we find could be 2, could be 3. And if it's a multi-million-dollar business, as we talked about before, the multiples could be 4, they could be 5. So every dollar you find is another $2 to $3 to $4, $5. And it becomes significant. And that's, I think, kind of the overarching thing about this. Is it significant, and can we prove it? And do we feel comfortable proving it? Because, we talk about books and records all the time. The better part of valor when you're going to sell your business, and Jessica, you're in the exit planning business, is to straighten all this stuff out before you get there.
I mean, like, look, guys, there's so many ways. And if you have a good we're not wealth managers, we're not accountants, right? But talk to your wealth managers and accountants. There's so many ways to reduce your tax liability without shoving all this stuff into your business. And even if that's your only option, like, what are we talking about? Like 37 cents on the dollar that you're paying on taxes. And then in the future, you're giving up that multiple of earnings on that dollar of 2, 3, 5 times. So it's just got to be, is it worth it or not? We talk about a lot, like, you can't steal cash twice, right? You can't not pay taxes on something and then decide that you're going to get a multiple of earnings on it. That goes into that whole other bucket too of pure cash and not documenting that in a business. But this episode was really meant to go through the add backs that defined by EBITDA and SDE. We can definitely adjust those to get your earnings number higher. And then some of the ones that can be legitimate if they're significant, if they're documented, and they're easy to prove.
Yeah. And all of this will help build the value of your business. Of course, again, people want to look at the front page of your tax returns and see most of this, right? So if you're looking at someone's front page of their tax returns, right on the front page is is their earnings, right? On the front page is the payroll to officers, right on the front page, depending on what kind of entity it is, but interest and depreciation. So banks will look at those numbers and be like, there it is. There's the money right there. If we have to go to the back page where all the cars and the phones and the meals and the entertainment and the travel, banks don't love that. And we always talk about, getting top multiple. You're not going to get top multiple for those dollars. In fact, because of this cloud, because of this grayness, because of this mishmash, your whole value, every single dollar may be brought down in a multiple because it's not a solid, legitimate business. So you may be missing out on multiples on every dollar because you've really done a horrible job with books and records.
Yeah. So I think we've hammered this point home. However, I know this episode is like, there's like people sitting out there and you'd be like, well, what about this? And what about that? And what the best advice we can offer you is if you have follow-up questions, if you still want a better understanding of the process, reach out to your local Transworld office. We'll do a complimentary meeting with you. You can talk through your personal situation, even if you just want to get an idea of like, am I doing this right or wrong for the future? So as you know, we have over, I think, 800 Transworld agents now across the US and across the world.
Over 900.
900. So there is 900 people. There is someone in your market that can sit down and go through this episode with you in further detail about your business.
Yeah. And we, of course, always have a great deal of the week and a listing of the week. So enjoy.
Let's get to it.
Transworld Business Advisors is the world's largest business brokerage and mergers and acquisitions firm with over 500 brokers in nearly 200 offices worldwide. Transworld's team handles thousands of business sales every year. To be connected with a qualified business broker or learn more about the buying and selling process, visit tworld.com/the deal board or call 888-719-9098.
Hey, Andy, do you know what time it is? It's time for our deal of the week.
Deal of the week. Sold.
Hey, welcome back, everybody. It is Deal of the Week, and I have Daren Bucklin, my franchisee partner from Transworld Business Advisors of Portland. He's such my partner that we wore the same shirt, which if you're listening to this, you wouldn't realize. But anyway, Daren, deal. What do you tell us about it?
Deal of the week. We're closing this week on a vocational school. It's been around since 2008, specializing in training for frontline caregivers. Closing price of about $900,000, $650,000 cash with a $250,000 earnout.
Nice.
Sold to a larger university that's coming in and in acquisition mode. So they're looking forward to expand, and I think it's going to be a great marriage between the two.
Yeah, strategic buyer in the educational space. The educational space, huge, right?
Yep, absolutely.
So
it's a very growing industry, especially frontline caregivers, and also a lot of vocational opportunities. This university specializes in providing job opportunities, so it's a hot space right now. Any employer directed training.
Wow. Sounds great. And so this is a good deal for a strategic buyer, and the seller sounds like they got a great deal. So
You got a great deal, retirement package, employment agreement. So yeah, both parties are super happy.
wow. So if anybody else in the educational space wants to reach out to you, Daren, what's the best way?
503-820-0063, or you can always reach me at dbucklin@tworld.com.
Excellent.
Hey, Jessica, you know what time it is?
Money time?
Almost. It's time for listing of the week.
Hey, welcome back, everybody. It is listing of the week, and we have Aaron Wills with us talking about an HVAC company, right? Nice one.
Yes, sir. It's very nice. It's been around for over 20 plus years. It's in the Tarrant County area. Cash flows pretty well, right at that $175,000 a year mark. The unique part about the business is the real estate is owned by the business, and it has 2 income producing properties, 3 buildings. 2 of them are income producing. 1 office is the heating and air company itself. So the perfect kind of buyer for this is going to be maybe another HVAC company that wants to have its own space it's currently renting.
Nice.
That also would be interested in growing their book of business pretty well. And they'd be able to have some income as soon as they walk into the door.
Excellent. How much are they asking?
They're asking $800 for the business, and the real estate will be just over $1 million.
Excellent. Sounds like a great investment for a company looking to grow, or someone just wants to buy a great business, great service business, right?
Absolutely.
All right. What's the best way to get in touch with you, Aaron?
Best way is going to be call me 817-725-7221, or you can email me at awills, AWILLS @tworld.com.
Thanks.
Thank you.
Thanks for tuning into the show today. If you like the podcast, share it with your friends on social media. And don't forget to subscribe and leave us a review on your favorite podcasting app. If you have questions, would like to appear, or have suggestions for topics for the show, get in contact with us through our website, thedealboardpodcast.com.